You sit down at the kitchen table, type your salary and mortgage balance into an online insurance calculator, hit calculate, and feel a brief wave of relief. You've done the responsible adult thing. But this chart shows a different reality. According to the Association of British Insurers, average UK households are underinsured by roughly £150,000. The immediate risk isn't even death, it's illness. If unable to work for 6 months, lost earnings typically hit £12,000. The underlying math in these online calculators works perfectly fine. The failure happens because the default assumptions they rely on are stuck in a traditional household model that ignores the cost of living in 2026. By relying on a rushed 20-minute session using optimistic default inputs, you inadvertently leave your surviving family financially exposed the moment they need that safety net the most. The first place these calculations collapse is the timeline. The most frequent error people make is tying the length of their life insurance policy directly to the remaining years on your mortgage. This diagram illustrates why that is so dangerous. If you have a 5-year-old child and a 15-year mortgage, a 15-year policy stops dead right when your teenager starts looking at university. The standard advisory rule is to cover the longer of your loan balance or the years until your youngest child turns 21. During those unprotected gap years, your surviving partner would be facing student loans company estimates of over £19,500 a year in combined tuition and living costs, completely unsupported. Then come the hidden, recurring expenses of your actual life that basic calculators never ask about. Wraparound care, after-school clubs, and holiday camps easily demand £5,000 to £8,000 per child per year. If you currently provide unpaid care for an elderly parent, your absence turns that into a paid service, costing £15 to £25 an hour. Even older family pets require ongoing insurance and care that easily approach £150 a month. And if you are the one who usually handles the household repairs, your partner suddenly inherits the cost of hiring tradespeople, a line item that requires budgeting £2,000 to £4,000 every year. Take the case of Rachel, a graphic designer with 2 young children. A standard calculation suggested she needed £280,000. When she manually factored in childcare, pet care, and a realistic home maintenance budget, her true baseline climbed to £415,000. To bridge that massive £135,000 deficit, the difference in her premium was exactly £11 a month. Systematically omitting the true running costs of a household to save the equivalent of 1 takeaway coffee a week is precisely what drives the national £150,000 underinsurance gap. That gap gets even wider when we look at daily survival. Life insurance pays out if you die, but you are statistically far more likely to be off work for 6 months due to a serious illness. Yet income protection, which replaces your monthly salary, is frequently skipped entirely. When people do buy it, they often fall into a definitional trap. If a policy specifies any occupation, the insurer will not pay out if you are physically capable of doing any job at all, regardless of your actual profession. You must secure own occupation cover to ensure protection for your specific role. You also have to precisely calibrate your deferred period, the specific waiting time before the policy actually starts paying out. If you get 6 months of full sick pay from your employer, a 26-week wait keeps your premiums low. But if you are a freelancer with 0 sick pay, you need a 4-week wait, or you face an immediate cash flow crisis. Finally, look at this graph of the pricing structure itself. Reviewable premiums often look 20 to 30% cheaper on day 1, but insurers reprice them every few years, and they rapidly curve sharply upward to cost far more than a fixed, guaranteed premium ever would have. Choosing the wrong definitions, especially for gig workers and freelancers who lack traditional employer benefits, turns what should be a reliable safety net into an unusable, expensive liability. You cannot rely on the state to fill these gaps. In 2026, statutory sick pay is under £120 a week, and it abruptly terminates after just 28 weeks. Similarly, bereavement support payment is structured as a lump sum with monthly installments, capping out at 18 months. It is a temporary fix, not a vehicle for long-term household survival. To calculate your true coverage need, you have to do the groundwork before opening any tool. Gather your actual payslips, write down your precise debt balances, and calculate an honest average of your household's monthly outgoings. With those real numbers in hand, the most effective tactical solution is to run an online estimator, like the Cost Saver calculator, twice, to establish a realistic baseline. Run the first calculation using a polite, optimistic view of your expenses. Then run a second calculation using a fiercely pessimistic, honest accounting of every single outgoing cost. Once you have that honest figure, you need to lock in your rates quickly. Baseline premiums naturally rise 5 to 8% for every year you age. Running your uncompromised data through a dual-run calculation today is the only way to stop hoping for the best and actually secure your family's future.